I'm John Byrne from AML Right Source, and we're going to create a regular monthly cadence with our guest today, with Sarah Beth Felix. Sarah is, among other things, the author of a publication she recently started called the Dirty Money Weekly. And Sarah also has been extremely active in our space for quite a while, and really happy that she's going to spend some time with us each month, getting some her initial reaction to some issues, give you some recommendations regarding operations, regarding policy, and all those sorts of things. And the way we're going to do this is we briefly talk before we record. She can handle any topic under the AML umbrella, and then we're just going to go like we're grabbing coffee and chatting. So first, Sarah Beth, thank you so much for joining. We really appreciate it.
Yes, thank you. Thank you. I know that we have a lot to talk about, so I will save all of my thoughts and I will bring my coffee to this chat that we're going to have. So I look forward to your questions. Thanks, John.
Sounds perfect. All right, let's start off with your most recent edition of Dirty Money Weekly. You talked at length about a recent FINRA enforcement action, and we can briefly describe FINRA, but the point that I would like you to amplify, like you did in the newsletter, is why an enforcement action by that self-regulatory organization is relevant to whatever financial institution you may be part of because of some of the themes in there. So talk a bit about that.
Awesome. FINRA is kind of the horse to put your money on when we look at the next couple of years and any type of penalties or EAs. Enforcement actions, consent orders. FINRA, I believe, is not politicized, and that's why they can move forward with the things that they require of their member firms. Particularly the two cases that I talked about were of interest to me, and not just because I used to be a Series 7 broker, but I can never leave that life, but also it's, without bank partners, without their traditional FI partners, none of these shenanigans that all these firms did would be possible, which means not that banks and traditional financial institutions are the de facto regulator of these non-bank financial institutions. I'm not saying that. In fact, the manual clearly states that they're not. However, the risk does get transferred in a way to their bank partners. And I think bank partners that don't ask that question, that ask a first or second level question of their non-bank financial institutions, really leave themselves open to not just regulatory and reputational risk, but also missing out on filing a suspicious activity report, which is a control issue, which is why most banks get in trouble, right? They don't get in trouble for transposing, a date of birth on a CTR. They get in trouble for not reporting suspicious activity. So that's where banks and credit unions, who are the partners of these firms, need to really be asking those questions like, hey, I see that you're in the securities industry. Who is your regulator? That's a great top level question, right? That is a 30,000 foot question. Right. And most banks aren't even asking that question. And I think depending on the volume and the destination and the source of funds that come in and out of the account should drive additional questions. And I'm not seeing that basically in any traditional financial institution client of mine that I work with. None of those questions are being asked. It's like, oh, well, they are regulated by the SEC or by FINRA or by the CFTC. Someone else is looking at them. Well, that doesn't exempt you from being aware of what red flags that you should be looking for in their wires in and out and in their downstream customers. So
that's a training issue for the traditional financial institutions, obviously. Why do you think it is that you sort of just said that, I guess, that they feel they're being regulated, but it seems to me that would be logical that the AML professionals within the traditional institutions would recommend to the wealth management group or the business line group or whatever, hey, this is just an additional question you should ask. Have you gotten any feedback from your clients why they don't do that? Is it simply because they say, well, we simply know they're regulated, even though they don't know who the regulator is?
No, I honestly think it's because they don't want to know. Now, yeah, I think when we look at money service businesses, a different type of non-bank financial institution, banks want to know because there's typically fees that they can attach to their volumes, right? To their cash volumes and things like that. So they want to know, so they ask those questions, or or they want to know if they have a private ATM on site. So they ask those types of questions, but they aren't asking, hey, I see that you're a broker dealer and you've got, tens of millions of dollars flowing in and out of your accounts every month. Can you tell me what you do? I mean, it's just it's something. It's like a disconnect. It's very, very odd. And of course, I can't help but think it's kind of related to the general approach that we've taken to the investment in securities industry in the U.S., which I think going back to 2002 was the first time we tried to impose certain regulations. Then
Right.
2003, then that failed. Then 2015, then that failed. Then 2024, then that just right at the end of last year got pushed off to 2028. So to me, that almost gives a general air of, well, we don't really care from the FIU
Right.
level down to the bank. So I don't know.
That leads me to another related question.
Mhm.
We've done some conversations internally at Right Source with outside experts, and one of the questions we've asked them is, what do you see as the change in both tone and theme regarding supervision in general? And without prejudicing your answer, one of the answers was, regardless of whether you think there's a lessening of oversight, you would make a mistake as a financial institution to believe that if you get rid of resources or you reduce training or whatever, that's not somehow going to come back and bite you later. So as you do advise clients, I call you up and I say, hey, my board has just said, look, from based on what I've heard from the Fed, they're getting rid of staff. The OCC's comments, they seem to be focused almost mainly on crypto as opposed to enforcement action. Isn't this an appropriate time to not hire new resources or to reduce some? So what would be your comment if I come to you with that premise?
Well, I've already fielded several calls like that, unfortunately, from the community bank space and credit union space. It is unfortunate. The thing that I tell all of my clients is it is something where you actually have to be more high touch with your board, and you start having to engage them in the conversation, because from the top level down, the priorities, and I don't mean the national priorities, which I'm
Right.
sure we'll talk about, but the actual priorities are focused on the TCOs, FTOs, and SDGTs. And a lot of times that doesn't get enough play in the community banking space, because
Right.
now there's a criminal component attached to what was simply a sanctions issue with FTOs and SDGTs. Now, with that criminal component, that's something that I think you can use to scare, if you will, scare in a respectful way, your board that's asking you to lean out either your systems or your people, because now things have changed. It's gone from this focus on let's find all the structuring and report it to now we have to find nuanced, very difficult to find shell companies and front companies that could be related to the cartels, right, that are tied
Right.
to an FTO. Now it's a lot more complex, and that messaging has not reached the board. It's still very numbers, it's still very much constrained by the KPIs that the board wants to see. Well, you need to stop doing the KPIs, because that has nothing to do with the nuance that is required in the investigatory time that's now required. Because when you look at something like structuring, that's an easy thing. That's an easy thing to report. We're looking at something very nuanced, very, very difficult to find. You have to find indicators of a shell company or a front company, and then you have to do all the research and go find, and it just kind of balloons out. But that message isn't happening. It's not moving to the board, and that's what my thing has been. You have to start educating them on what it takes to find an FTO or a cartel, right? So.
Well, that makes sense. And also, I think in terms of the criminal statutes, the statutes of limitation are fairly lengthy, at least 5 years, if not more. So, in terms of looking at corruption and other white collar crime activities, if you let your guard down, that could catch up under a a new and changed Justice Department or someplace else, or a state level prosecution too. Obviously, that's the case. Another issue that is getting a lot of play. We have talked for a number of years about the issue that we used to call de-risking, and now they call it debanking. But basically, it's decision made by a financial institution to either not onboard a potential client, or exit a relationship based on their analysis, either that the risk can't be managed or the risk is can be managed but problematic given regulatory oversight. And so that's in that space. I've worked a lot with colleagues in the humanitarian world, and they continue to struggle to ensure that they can get financial access and that there's financial inclusion in that space. But sort of a unique turn of events recently has characterized the debanking issue as one that goes against political beliefs or religious beliefs. There was actually a study done only by the majority on the House. It was only a Republican report. It just was. It wasn't done by both sides. And it said that there was discrimination against gun dealers, private ATM owners, and other religious groups, which on the third one, they really didn't make the case analytically, in my opinion, from looking at the report. But in any event, the president last weekend announced, and they have filed this case in Florida, that they were going to sue, and they have sued JP Morgan Chase. And reading from the Washington Post description of this, alleging that in 2021, they improperly, again, right after January 6th, closed his account and sought to, quote, blacklist, unquote, him and his family. They're seeking $5 billion in damages. There's always billions involved with Trump litigation. So that part's not a surprise. But from an operational and a policy standpoint, again, this case is going to play out. JP Morgan said, we're going to defend this. We make decisions based on risk. And obviously, other institutions have been criticized by this administration for similar account closings. B of A was one that was criticized. Just from a standpoint of what a negative outcome, meaning a court agreeing that there'd been discrimination in this particular case, what could that mean for the AML community based on your vast experience?
Oh, that is a tangled web. I think, I did pull down the case from Pacer because I wanted to read it. I do now
Sure.
a lot of expert witness work, so I'm really into Pacer a lot. I'm always reading stuff. And the thing that kept striking me, and then I will get to your question, was that they kept mentioning this blacklist. And I had posted on one of my LinkedIn folks, Susie, I had posted when she had posted about it. She's from Canada, so she was looking at it from a different perspective. And the thing that I kept not finding was how they defined this blacklist. And I was like, great, they keep talking about this blacklist that every bank pulls from. And my mind went to, is it check systems? Is it early warning systems? Is it 314A? Is it a SAR thing?
Right.
What is it that they kept this nebulous term? And of course, from that perspective, I thought, well, this case doesn't have a very good chance of going forward because I don't think they defined what this blacklist was. But
Right.
I think if we take the politics out of it, which I feel like we're going to have to do a lot, which is what our role is in the financial crime function,
Absolutely.
not see it from a political lens.
Right.
I think the underlying issue is what we've all been trained on since the beginning of my career, is that if a SAR exists, you cannot even say, no, I did not file a SAR. You just have to say, I can't answer that question. You cannot say yes or no. It's so protected. And then now we're going to see these cases where they are talking around the existence of something that could indicate a suspicious activity report was filed for whatever reason, right? It could have been a nebulous reason.
Right.
It couldn't, it doesn't necessarily have to be, this is the president and this, and I'm filing the SAR on the president. That's not necessarily the body of the SAR, but we can't disclose that either, right? And so I think for financial crime professionals, especially in the US, we have to be able to and this is going to be very difficult, almost impossible. We have to be able to satisfy the spirit of the law, which is to find illicit activity and illicit actors and activity that we can't necessarily explain with reasonable measures and report it in a timely fashion. Now, whether or not that gets picked up by the agent who reads it or not, that's up to them. But our role is to find it. Now, if we find that that customer presents too much risk and you don't have the right technology, and this doesn't just go for the POTUS, right? This goes for adult clubs, weed dealers, right? All these other things that are lawful businesses, right?
Right.
This goes back to that debanking thing we talked about last year. If you decide to exit a business or increase the fees to account for the additional monitoring that has to happen, it can no longer be just an email from the chief AML officer saying, I need to do XYZ. It now needs to be board approved. It needs to be vetted. It needs to have, which is unfortunate because we're already taking an understaffed position and now we're adding more stuff to it just to CYA. So that's not exactly a bright, a bright light, but that's the truth. So
No, and there's a danger that if you amplify that with the board, there could be leaks too. So that becomes problematic. Going back to your comment about not being able to say why an account is closed. I remember one of the first conversations we had 10 years ago with the humanitarian world. They asked a legitimate question. We get these letters that are closing our accounts, but never told why. And when I explained to them what you just did, they went, "Oh, no one's ever told us that." And so they didn't like the answer because they wanted to make, could we make adjustments so that you'll take the account? But they understood federal law being, at least at the time, something enforced that if you disclose the appearance of a SAR, there's legal issues there. So I think that's important. I would just add that right before we started to record, I did see something on LinkedIn about the UK, and I think it was an opinion piece as opposed to an official posting, but it said something along the lines that in the debanking space, that banks need to sort of change their process regarding customers that are engaged in crypto. In other words, you should not eliminate or not onboard or debank customers simply because they are transacting in cryptocurrency. So that was interesting. So I didn't read the context. I don't know what the data was behind it, but clearly in the UK at least, like in the US, where there is certainly a more embracing of crypto than there's ever been. The UK at least is making the comment that if you're going to make a decision, a risk decision, to your point, it has to be backed up by a very specific rationale. Not that you're telling the customer that, but that you have to have that internally. So I think that's important, which leads me to shift to a couple of studies came out in the past week, one by Chainalysis, another one by TRM Labs. Both entities do crypto crime updates. The one from TRM Labs just came out the other day, and actually Elliot and I talked about it in our weekly podcast, but they concluded that $158 billion of illicit crypto occurred in 2025, which was a 145% increase from the previous year. Again, that's just one of the highlights. There's other things in there. Any comments just in general about where we are in the cryptocurrency environment that we are here in the States and obviously globally?
Well, when I see those reports, the first thing in my mind is the fiat world never does this, right? Like, we have never in the history of banking ever published a report and said X number of customers or wallets or accounts are directly tied to this type of illicit activity. And so I know there's a lot of hate about what happens with digital assets and how easy it is for criminals to use. And, there's always people comparing, this is the latest stat about fiat dirty money and this, and then these reports that you're talking about. And I think for me, my position is I love the fact that we're able to say this, here's the number and dollar of illicit, dirty actors and dirty money that we have in the crypto space. I wish we could do that in the fiat world. I mean, I wish that we
Right.
could share information between banks, right? The only information that we're allowed to share is with, regarding whether or not somebody has caused a charge off at a bank, right? That type of information. But we don't share, hey, I filed a SAR for human trafficking on this customer and I got a request for backup documentation. That's a pretty,
Right.
surefire way to say this is an illicit actor or account. And we never do that in the fiat world. So I'm not familiar with the specifics, but I will say there is something good about the fact that we can actually put numbers and dollars around the dirty stuff that happens in the digital asset world. So
Well, I appreciate that. So, our last topic for this month revolves around the broad area of fraud, fraud being obviously one of the national priorities, but also there's been some recent fraud alerts targeting healthcare related fraud. Talk a bit about both what the alerts are telling your clients and our community and just your general thoughts. Obviously, fraud, broad topic, continues to explode. Every banker you talk to always starts off with how much fraud is challenging institutions. So talk a little bit about the alert and then just other things. What are good strategies going forward?
yeah. So, I think I think one, we have to again take the political component out of it. And fraud is fraud. And I think most financial institutions are focused on a more transactional fraud because it causes an operational loss for them. So it's easier to justify getting extra people when your customers are being defrauded and you are having to, pay, or your insurance policy is having to pay. So I think that's a different type of focus on fraud. I think that fraud clearly still needs to be tackled. But the other type of fraud that came out in this alert published a few weeks ago, specifically about what's going on in the state of Minnesota and two counties of Minnesota, I think if we take the Minnesota out of it, we take the politics out of it, it's still very much relevant, right? So let's take that same thing and let's talk about Florida. I see this all the time in Florida. Clients in Florida, and they have individuals, or they have sole props, LLCs, that are getting tons and tons of deposits in from Medicare, from Medicaid, or from the state. And then you see luxury purchases that are going out. I mean, this is old as time, right? That is the most basic typology. Now, they did talk about that a little bit in this alert, but I think the thing that most people have to start looking at is fraud from a more than a transactional level. So it's got to take it. It's got to be taken up a notch in terms of your viewpoint. So it's not just a check fraud issue and Susie's account. It's an LLC that's getting a ton of ACHs in with some of the descriptions that I put in my Dirty Money Weekly. I'm going to try and go off the top of my head. I think it's contains the word USDA or contains the word FNSTREAS. There's different descriptions that are in these ACH descriptions that you can actually isolate and monitor, and then look for all the money that's going out. Is all the money going overseas? Is it going to another personal account? Is it going to Ferrari? Right? I mean, there's a whole bunch of things that you can look for, and I think that first step, most banks are not doing. They are conflating the transactional level fraud monitoring of an account takeover, or a P2P fraud, with this type of fraud, and this is a different world.
Yeah, the whole issue of fraud, many of our colleagues tell us that part of the problem, besides what you've identified, is that many of these government programs, when they simply send checks out, the vetting process either is poor or non-existent. So I remember, and you remember, of course, during the pandemic, when those checks started going out, the banks were saying, "Oh, time out, man. We're going to get a ton of fraud here," and we, of course, did, and there's still prosecutions for that, just because of the way the process is crafted. I mean, policymakers, office holders, they said, let's get these checks out as quickly as possible because everybody is hurting or can benefit or what have you. But there's a downside to doing that, and it's harder to put a guardrails around these things. But it sounds like they need to be a combination of banks potentially doing more based on good information from the government, and the government having better protections around their own programs, right?
Yes. And we saw that with the PPP, like you said, the two departments that should have been talking to each other are on the same hallway, and they weren't.
Right.
The was it SBA should have talked to the my brain is failing me, IRS, and
Right, yeah.
it should have been, hey, we see this company and they say they have 10 people working for them. What do you guys see? Oh, nothing. Oh, let's not fund the wire, right? I mean, that's pretty. I mean, the bar is on the floor there in terms of being able to use the same data. So, and that's where, unfortunately, because that's not done really well, it passes the risk on to the banks, and then banks are already overworked. So now they're serving as the proxy arm of the government, essentially, which is unfair, which is really, really unfair and unsustainable.
A quick last point on that. A colleague told us that for the pandemic fraud, they identified the fraud, they were able to claw it back, and went to the SBA and say, we want to send you back the money. And they said, we have no way of taking the money back. And the bank's like, we're not keeping this because this is fraud related. So I'm not sure how it was resolved. But that is a real story from one of our colleagues. So,
oh my goodness, that's terrible. I hadn't heard that, but I guess I'm not surprised at this point.
Right. Well, Sarah Beth, thank you for spending this monthly conversation with us on this. Again, Dirty Money Weekly. Does it come out the
Monday
same
mornings.
day?
Yep.
Monday mornings. Perfect.
Yep.
All right. And
unless it's a holiday. So, yeah.
Yeah. If you're not already connected to Sarah Beth on LinkedIn, you should be. So thanks for the time today. Really appreciate it.
Thank you.